Now, let's devote some attention to life insurance. Earlier I said life insurance that you own is included in your estate. We need to talk about what ownership means. So let me restate the rule in a different way. If you're the insured under a life insurance policy and you have an incident of ownership over that policy, then at the time of your death, the death benefit payable under the policy will be included in your estate for estate tax purposes. And you're going to be considered the owner of the policy if, first of all, if you're the outright owner. But even if you're not, if you have the right to name or change the beneficiary under the policy, you'll be considered the owner. Or if you have the right to surrender or cancel the policy and receive the cash value, you'll be considered the owner. If you have the right to transfer ownership of the policy, you'll be considered the owner. Or if you have the power to pledge the policy for a loan, you'll be considered the owner of that policy, or the power to borrow against it, or even the right to convert a term policy to a whole life policy. Those are all incidents of ownership. In estate planning, we need to pay attention to those rules because you might have those powers in an indirect way. Maybe you control a company that owns the policy, or a partnership that owns the policy, or maybe you're trustee of a trust that owns the policy. And we have to make sure that you don't have these incidents of ownership through those types of positions. Let's start with some common will scenarios, and let's begin by looking at a simple husband and wife situation.
This slide depicts a simple will, and let's assume it's one that would apply after 2012. In other words, in this case, the husband has an estate of $2,350,000, and his will does the simple thing.
It says, I give everything to my wife, so that after his death, she'll receive everything, and her estate will be $2,350,000. And then at her death, the children receive everything. Very simple will. Lots of people refer to this as the I love you will. But because of the tax implications of this, maybe it's less than a complete I love you because there will be a tax cost to doing it this way. Now let's look at what's happening here. The husband gives everything to the wife. Now the first rule that I want you to keep in mind when it comes to estate planning, that transfers between spouses when the receiving spouse is a U.S. citizen is not subject to tax. And that's the result of a thing called the marital deduction. So when the husband dies and his will says that his wife gets the full $2,350,000, and if the wife is a U.S. citizen, there will be no tax on that transfer, no federal estate tax and no Connecticut estate tax.
But look what happens. In that case, the wife's estate is $2,350,000. Keep in mind the federal estate tax exemption in 2016 is $5,450,000. So when the wife dies, because her estate is less than $5,450,000, there will be no federal estate tax. On the other hand, keep in mind that the Connecticut estate tax exemption is $2 million. So when the wife dies, if the Connecticut exemption is $2 million, that means her estate would exceed the exemption by $350,000. The tax on that would be about $25,000.
Now that's the way the taxes would work with respect to this simple will plan. Also, keep in mind that if this couple is worried about nursing home costs, we have no protection built into this plan to protect any of the assets from any types of claims against either one of these individuals. And one of those claims, and one that people are often worried about, involves the costs of long-term care. So think about the fact that when the husband passes away and the wife receives everything, and she's got $2,350,000, now, if she becomes frail and unable to take care of herself and long-term care is necessary in a nursing home or at home, the fact that she has that $2,350,000 will disqualify her from getting any state assistance for long-term care. Typically, especially with the elderly clients, we like to talk to them about, instead of giving everything to your surviving spouse, perhaps you want to think about putting some of the assets in a type of trust that will provide some protection for those assets with respect to those types of claims that might exist. And those claims could be any types of creditor claims. If the surviving wife got into trouble with creditors, it would be the type of trust that creditors could not get access to. Or if the surviving spouse needs to go into a nursing home, then it would be drafted so that the assets of the trust would not be counted would not be counted as hers for purposes of qualification for Medicaid or Title 19 benefits. Now, this is a different type of will. It's very close to the simple will that we just talked about, and it once again offers no asset protection when it comes to protection against the claims of creditors or protecting assets from the costs of long-term care. But it does involve or include an opportunity to save some taxes. And we call this type of will a disclaimer will. In this case, the husband, who has $2,350,000, has a will, and once again, it gives everything to his surviving spouse. And as we talked about before, if everything did pass to the surviving spouse, then there'd be no tax, assuming the surviving spouse is a U.S. citizen. In this situation, though, the husband's will includes a tax planning option for the wife to exercise shortly after the husband passes away. So what happens here is the husband's will says everything goes to the wife, but then the wife looks at the situation and says, I appreciate the fact that my husband has left everything to me, but if I receive everything, my estate will be $2,350,000. That's more than the estate tax exemption, and that means when I die, there'll be an estate tax to pay. So I don't want my estate to be more than the estate tax exemption. I'm going to reject the inheritance that my husband is about to give me. I disclaim an amount equal to my husband's Connecticut estate tax exemption. Now she could choose to disclaim any amount. It doesn't have to be the exemption amount that she disclaims. But if she disclaimed more than that, then there'd be a tax on the amount that she disclaimed. As long as the disclaimed property is less than the available exemption, there'll be no tax. So she could disclaim up to $2 million without generating a tax. And that's what this picture tries to illustrate. In this case, she says, I disclaim $2 million, and the disclaimed property moves over to a trust. Now, we talked about a trust a little bit earlier, and in this case, the trust would provide, it typically provides, it could provide all sorts of things, but the way we like to draft them is it provides that the wife is going to receive all the income on that $2 million for the rest of her life. And typically, it's not unusual that the wife can have the power to withdraw up to 5% of the trust assets every year. So that's what she'd have an absolute right to. She could also be a co-trustee of that trust. And then at her death, it passes to their children. In addition, like I said before, she's entitled to all the income from the trust, and she's entitled to withdraw 5%. If she needs more, then she's got to ask her trustee for it, and it's her trustee's job to evaluate that request and make sure it's reasonable. So in this case, the wife disclaims the $2 million, and it goes into what we call the disclaimer trust. Everything else will pass outright to the wife. When the wife passes away, her estate will be small, $350,000, well below the estate tax exemptions, and at her death, it passes to the children tax-free. The disclaimer trust has been sheltered from tax by the husband's exemption of $2 million. So when the $2 million passed to the disclaimer trust, there was no tax on that because the husband's exemption covered it. And now the assets are in a trust. It's a type of trust that even though the wife is the beneficiary, it will not be included in her estate when she passes away. So that will also pass to the children tax-free. So the children have ended up with the total of $2,350,000 without reduction for any taxes.